Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhardt, and Emily Sander.
We are back with the Private Equity Experience, and today we are adding a new acronym to the mix. PC.
Oh my goodness. PC.
Not your computer, not PC versus Mac.
Not being politically correct either.
Not politically correct. That's not this podcast at all. We're talking private credit and private equity. How these are different and how they frequently go together.
Yeah. And they frequently do.
Yes. Okay. Who wants to start with the what is private credit? You just talked about private equity. What is private credit?
Well, I'll start by saying it's a term that you hear a lot more now than you did, say, 10 years ago. But the fact is, it's not a new phenomenon. Ed and I have been working with private credit partners for damn near 20 years now. To take on a little bit more of a terminology position in the market as a separation from basically accessing debt financing through banks and other, fixed income markets. But in the name, it's implied. It's private. It's a private market access to debt. It goes alongside private equity. There's some similarities and a few differences too.
Wait, so it's private, meaning it's not on like a publicly traded market. It's credit, which is like debt. It reminds me of like a credit card debt. Is that?
Yeah, you got it. I mean, there are some large firms, just like there are some large private equity firms that trade their shares in public markets. But what it really means is you're a private sector access to financing for your business or your assets.
Okay. What would we have some similar players though, right? Like we're still talking LPs or whatever that's called on the PC side. We're talking like endowments and insurance companies, and those are the same people funding PC.
That's right. Yeah.
Right. Okay. And then like what's different about like the hold times or like that, or is it more or less risky than private equity? Like what are we talking about?
That's maybe a great place to start. Risk. And I'll just kick it off and Ed can wonk it out because this is Ed. I'll just sit back and listen to Ed. Out. But yeah, remember everybody that, when you look at a capital structure, there's levels of risk, generally speaking, to the different levels in your capital structure. Or otherwise, as we say in our book, the capital stack. So on the top end, lowest risk is your senior lenders, because you have other folks below that take the first hit before anything happens with that senior debt position. And below that, you have potentially mezzanine debt, which is sort of if you want to think about it really simply, it's kind of like a hybrid between debt and equity. And then lastly, you have equity, which is at the bottom of the capital stack, represents the highest risk, but also the highest return. And so that's the basics. Ed can walk it out from there. Probably sprinkle in risk premium in terms of that description.
Yeah. So at each one of those, let's call it 3 basic levels. So you've got and each one of these components breaks into a bunch of subcomponents. So you could have senior secured, senior unsecured, junior secured, junior unsecured, specific secured, and then you could have unsecured mezzanine, and then you could have mezzanine with participation, and then you can have preferred equity and equity. And I mean, the capital stack could look like a rainbow. And a financing rainbow with all sorts of different colors of stuff in there. So do
you want to briefly explain like the function, like why there's different, not each specific one? We were like in high school for a while with like senior and junior, and then we moved to like secure, insecure, like just generally speaking, what are all those things you mentioned?
So generally speaking, each one of them has a different risk premium associated with them. And so the one that's at the top, so senior secured, essentially says, look, we get paid first. So anything happens with the business, we get paid first. And our position, our debt is also secured by something specific. So it's not just a general debt of the business. It may be secured by patents. It may be secured by inventory. It may be secured by real estate. It may be. So not only do we have we get paid first if anything happens, but we also have a security interest in assets that we can seize that no one else can use to get paid.
Is it like a lien on a house or like a HELOC loan on a house?
Exactly. So your first mortgage on your house is your senior secured.
Oh, okay.
Then if you have a HELOC, they're going to be a junior secured because they're behind the senior secured. But they're still secured by the house, but the first position gets paid off first before the next one does. And so each one of those companies use those because they want to be able to get different levels of debt financing, or they want to be able to not have as much equity financing. Because again, as Rory noted, the equity is the highest risk, highest return. Your founders and kind of those folks, they have that initial equity. That's where the big up is. You know, you can get 10x. Okay, great. But the way you're getting 10x might be because you're using financial leverage, and that's the debt that's sitting here. And so you might go, well, I got senior secured debt, and they might be getting 6%. And then if you need more money, the next people come in and go, well, if I can't be senior secured because you already have someone in that position, I'll be a subordinate, kind of junior secured or junior unsecured. So I get paid next in the waterfall. And so then but I'm going to charge you 9%. And then you might get the mezzanine where they go, okay, I'm going to charge you 12% plus warrants. So that way I get a little equity play on this too.
That's the hybrid one, Rory said. So you're doing both credit and equity in that one?
Yeah, there's
a good place to be.
Equity place to be. Yeah, there's normally an equity option.
Be in the middle, the meat in the sandwich.
That's where you want to be.
Yeah.
Where a lot of these private credit plays is in the mezzanine, because you get a good coupon, which is basically your percentage interest rate that's being charged on the debt, plus you've got equity participation or potential equity participation, because they're normally warrants or options. And so you go, well, if it doesn't work out, I could, I'm not going to do it. And if it does, then I get, when a company goes public or sells, I actually get additional payment off of that transaction.
Can you be in multiple layers at once? Or
yeah.
Okay.
Oh, yeah. And I think you asked the right question up top is, do some of these firms participate in both private credit and private equity? Absolutely, yes. You look at like a Apollo or Ares Management or Blackstone. They have a private equity group. They have a private credit group. Probably have a special situations mezzanine group, which to Ed's point, the reason that you usually have a mezzanine slice of your capital stack is because there's a need to have a little bit more equity than you have to access like the debt that you need. So somebody comes in with this little special situation slice of the sandwich and sits in there with a nice position. So
what does that mean? What you just said? If we need more equity, we want to be able to.
So like if I have if I'm looking for as much debt as I can get, lender, a private credit lender or a bank will lend up to a certain amount of what you required to make an acquisition, let's say.
Okay.
That, Ed and I and the businesses that we've been in together, that's usually somewhere between 80 and 90% of the need. Well, let's say you can only come up with enough cash to get up to, 95% of the purchase price, right? So you have, let's say, $1 million portfolio you want to buy, you can get $800,000 of debt, but in order to access that debt, you need $200,000 of equity. Well, let's say you can only come up with, $100,000 of like just out of the back pocket of your investor's wallet. You may need somebody to come in and say, hey, I'll come to the rescue. I'll be the additional $100,000 and sit in between you, the equity holder, and the lender so that you can access this debt. Kind of how it tends to work.
Okay, let me recap what I think I know. There's a capital stack. On top of the stack is credit stuff.
Yes.
On the bottom of the stack is equity stuff.
Yes.
The credit stuff is less risky, but you get less return. The equity stuff is more risky, but you get more return. And then you can plug and play at different layers of this thing.
Yeah.
To finance. Okay.
Yeah. So you asked the question, like what are some of the similarities between these two? Private credit, private equity. A lot of it has to come down to the way these funds are set up is very similar. So you look at the investors in these funds, limited partners. They could be pension funds, endowments, all sorts of sovereign wealth funds, etc. It's just another alternative asset class. So big funds have big LPs in both private equity and private credit. So the compensation scheme is very similar too. Assets under management that you'll earn as a fund in private credit, and the same as in private equity. And there's a carried interest component, which you'll earn in both of those too. So there's functionally very similar in how they're managed.
If I'm an LP, why do I want PC versus PE in any given situation?
Well, PC is going to give you generally two things that private equity is not. So the first thing it's going to give you is steady cash flows.
Yep.
So normally what you're going to have on a private credit situation is you're going to have monthly or quarterly payments.
Dividend.
Interest or interest. No, it's interest or in principal returning. And so your money is now you're going to have to put it back to work, but you're getting a constant stream of cash. Where private equity, you might not see cash for years until that investment flips. So it's got a different cash flow kind of characteristic. And then the other piece is from a risk perspective, you are sitting kind of higher stack, and so it's less risky. And as a result, you may have a situation where you're looking at a company or you're a limited partner, and you're going, look, I've got X amount of equity exposure. I need some debt exposure, to kind of balance my portfolio. But the debt I want I don't want CDs. I don't want, kind of normal corporate bonds. I want to be able to get, a higher rate of return and maybe throw some equity juice in there with warrants and some of that kind of stuff.
Something sexy.
So I'm going to play in this private credit arena where I've got better cash flow, lower risk than on the private equity side, but I've got higher cash flow and higher risk than I would if it was a traditional bond or bank debt instrument.
Yep.
So to me, that then largely depends on what else is going on in that LP's world and in the portfolio. So it might be like, I don't know, is there a ratio of equity to credit they have to hit, or they
probably not hit? Not normally. Yeah. I think that actually could be a whole nother podcast.
Okay.
Characteristics of LPs, and because you're going to have some LPs. And I'll use an example like a college or university endowment where they need to spin off cash every year to help college with
asset liabilities management. Yeah.
Yes, they've got to be able to send cash to the university every year. The endowment does to be able to pay for scholarships and repairs to buildings and other things. And you may have others that are sitting there going, no, we don't need any current income. And so so if you've got one that is kind of leaning more toward, I've got to have some current period income, pensions tend to need current period income, insurance companies tend to need current period income. Actuarially, they're going to need to structure their portfolio in such a way that part of that portfolio is spinning off cash. So that's where I'll allocate some to a debt instrument where the probability of that cash and the predictability of that cash is much higher. And then the rest of it is longer term, and I can push that off and be less liquid.
Yeah. I mean, the other way to think about it, or just average person kind of applying it to their own lives, it's no different at all than kind of going to your financial advisor, Raymond James person, whatever, overpriced wealth manager, whatever that may be, and just be like, they tell you, well, you should have a portfolio of profit. How old are you? What are your obligations? Okay, you're pretty young, so maybe you should have 60% in stocks, 40%, or 60% equity, 40% fixed income. It's no different. You're just allocating orders of magnitude larger sums, but it really comes down to a fixed income strategy and an equity strategy, and kind of blending those together and making it from a risk return standpoint.
Yeah. And I'll sound fancy because this is true. Yesterday, I was talking to a ultra high net worth individual, and she had a VC firm where she was investing in portcos, but she was also looking to be an LP for VC and PE firms. Mm-hmm. And so she was like, look, I have cash to spend. She had certain things she wanted to hit in terms of mission and the impact in the world and certain things like that. But she was looking for good places to invest her money.
Absolutely. And, that's, you touched on a nice little subject there. And so, the same as how we've talked about in our book and on this podcast, what's the difference between, venture capital equity plays and private equity plays? There's early stage, more risky in the venture, less risky on the equity side. The same thing occurs on the private credit side too. So there's, venture debt funds out there, and there's private credit funds that act more like private equity mandates insofar as like the types of companies in the life stage that they're at. I work for a startup, myself, and we talk more to VCs and venture debt providers than I talk to around private equity and private credit today. It's just a mixture of like risk at the end of the day, and where a company's at as far as their life cycle is concerned. So two sides of the same coin, if you will, just to kind of put a button on that. But there's just some distinct differences on, as we talked about, that risk return profile. And a lot of times these two entities or these two asset classes work together. Like if a private equity group is buying a company, they need leverage to make that acquisition. If they can't get as attractive at terms as they want with one of the big banks out there, private credit is right there to lock arms with them and do a deal. And oftentimes they do a deal in the early part of it and then quickly get refied out once the company they're buying has hit a certain threshold where they can support bank debt and stuff like that.
Okay, so give me an example. If I'm like if we're a PE firm and the market conditions are such as they are, we talked about this last time, so I don't know if it affects it, where it's like, oh, in this market condition, we want more of this. Can you run me through a scenario where we would want to be in multiple layers of that cap stack?
Yeah, I can give you one kind of out the gate, which is if you're investing in a business, you may come in as preferred equity, for instance. And that business is kind of cranking along. It might be doing fine, but it's not performing the way you anticipated. And they need some additional cash.
Yeah.
And so you go, okay, instead of putting in more preferred equity, I'm going to put in mezzanine debt. So I'm going to basically put in some debt. So I'm going to get some cash out because they probably can't go to a bank, or we don't want to go to a bank because we're in either covenants or something along those lines where we can't.
Yeah.
But as a private equity firm, instead of going, I'm going to give you more equity, they go, no, I'm going to give you mezz debt, and I'm going to kind of charge you 14% interest, and I'm going to take another 10% of equity in warrants. And that way I'm more protected. I've kind of put a backstop against my other equity investment. So I get paid first and I'll get that money out. So if it essentially crams down more on the common.
Okay. Yeah. I'm going to switch tenses. We're no longer the PE firm. We're just podcasting. We're talking about this. So if the PE firm, you said the PE firm, they were charging 14%, like to whom?
To their portfolio company.
Okay. So they're saying you're not performing well. And we don't want to stroke a check, or we can't take out a further bank.
Well, they're stroking a check. They're just going, the check we're stroking is now debt, not more equity.
Yeah.
And you have to start paying us back right away.
Yeah.
Oh.
And we're going to charge you interest, and we're going to pass that through to the LPs, and you're going to give us more equity, founder, because you haven't quite performed the way we expected. But we think you will, but we're not going to, but the way we're going to put in more money is in a higher on the capital stack position that's going to get us cash flow now.
See that a lot too. I mean, it's just another form of a bridge loan, and a company that needs it, in a lot of these cases, you ask the question, well, why would somebody ever work with private credit or mezzanine lenders when they could go get bank debt? Well, banks move slow. Probably can't, and banks move slow. And banks are often a lot more regulated, which means their appetite for risk changes from time to time, right? So one thing that's consistent is the private credit market is a lot less regulated. There's more flexibility in structuring because they're non-depository institutions that have very specific capital requirements and things like that. There's a whole litany of reasons why there is in fact a private credit market that exists to be basically an alternative to banks. Because if the banks ruled the world entirely, there wouldn't be a private credit market, but there sure is, because of some of the challenges that banks have and folks have with working with banks from time to time.
Can we put some numbers to this? So we talked about private equity was like, I think it was like 7.5 trillion, and private credit was significantly less, like 1.7 trillion, but still we're talking like trillions with a T. Right?
And I read a stat today, even that's, by 2032, it's going to be well over 10 trillion on both sides. So private credit is probably growing faster right now than private equity, but private equity still is nominally bigger only because the credit market, let's just say the fixed income market globally, is many multiples bigger than the equities market. But because there's public securitizations, there's public bond offerings, there's bank debt, that means that like the bigger slices of the overall credit market, there's already big players in there. But private credit represents a large and growing proportion of all of that. So if you will, the pie is getting bigger of credit, but also the size of the pie with private credit's getting bigger as it becomes more accessible, viable, all of those things.
What's the name of a private credit company?
Gosh, I could name a lot of them. Blackstone's got a private credit strategy. Apollo, Ares. I mean, there's so many. I mean, I have a private investment business that acquires consumer bankruptcy debt. That can be considered both a private equity fund and a private credit fund, no matter which way you slice it. So it's just a term that means you're providing debt in a private market. So it could be a $1 million fund. It could be a, $5 billion fund, same thing.
Is it kind of like a bank has different divisions of the bank that do very different things, but they're all part of the same bank?
For the big funds, absolutely.
Yeah.
Okay.
Yeah,
absolutely.
Okay.
Yeah.
Well, and what's interesting is this private credit market, some of the banks have tried to get into it. SVB, Silicon Valley Bank, was extraordinarily successful for a long time, kind of working the fringes of this market and going, hey, we're going to loan, and they're going to be kind of with sponsor finance. So they had a sponsor finance group, and they would kind of work with private equity to provide the debt. They would get fund guarantees. They would get, participations,
exactly.
All that kind of stuff. And they were like the bank lender that played in this space. Mm-hmm. The problem was when they failed, they didn't fail because they weren't profitable. They failed because they weren't liquid. Mm-hmm. They couldn't get, there was a kind of run on deposits. They couldn't get these loans to, you can't sell them on a secondary market. They don't, they are performing, but you have to get certain level of liquidity, and they're illiquid relative to normal bank debt.
So are you locked in for a duration?
So in a lot of cases, if you're in a bank environment, traditional depository institution bank environment, they're regulated by both federal regulation, international regulations, so like Basel II, which is here's what your risks need to look like. And they can sell and do sell loans across and they sell participation in loans, and so they don't hold all this stuff on their books. They'll securitize it, which Rory was talking about, where so loans of certain types will
pull it up
in the market. Yeah. A lot of these private credit type loans, they're so bespoke as far as the terms and conditions and what they're kind of what sweeteners are in them and those kind of things that you can't securitize them, and they don't tend to play with participation, and they don't fit in the Basel II, type credit basket. And so if you want someone else to play, it's normally got to be another private credit fund. You can't just kind of go out and go, well, banks, why don't you want to play in this pool?
Yeah.
And so it's a different animal.
So if there's a run on the private credit, there's nowhere for them to turn to try to.
Well, the thing is, with private credit, there is no run, because private credit's not a depository institution. With a bank, a depository institution like Silicon Valley Bank, the loans on this side, on the asset side of the balance sheet, are offset by deposits on the liability side of the balance sheet. And so if all of a sudden people want a bunch of want their money back for deposits, the bank has to pay cash. Well, the only way to get cash is you have reserves, and then you've got the loans, and it's tough to bundle those loans up and sell them because they don't fit these buckets nicely.
Yeah. And that's why banks are governed the way they are so heavily, is so that can be avoided at the highest possible way, which is why you don't relatively frequently see a lot of runs on bank deposits and bank failures. I think the SVB one was kind of unique by virtue of the specialization Ed talked about. You'll never see. I mean, you're never going to see a Bank of America fail. I mean, it's not going to happen because of all of the regulation around that. And also just, they'll get propped up. So,
right. Yeah,
and SVB was kind of propped up even too, if you want to go down that hole. I mean, they were packaged up and sold for Citizens. But anyway, point being is the illiquidity aspect of the private equity and private credit markets presents more risk and therefore more return. But there's, the return's not guaranteed. Let's just say that. Okay.
And then if we're talking like numbers, so first of all, we talked about the characteristics. So for private credit, you're getting paid out monthly, not dividends. What was the word you used? Interest.
It's going to be interest and principal.
Interest and principal. Okay, so those are paid out and boom, like slow drip every month. The private equity is a big slug at the end if you do well. Yes?
No, that's a good generalization. It's not. Yeah, I mean, that's every situation specifically different.
Broad strokes. And then for the private credit, is there something at the end or is it just the slow drip?
Depends. Yeah, there could be if there were warrants attached to it.
Okay.
Then there could very well be equity that kind of converts into equity. And so when the company transacts, they end up with another slug. Or, but that's generally going to look like a warrant or an option.
But put some numbers behind it, though. Think about maybe your typical private equity return profile is probably twice what the private credit return profile is. So you might be looking at a 15 to 25% rate of return expectation on private equity, somewhere between 7 and 12% on average on private credit, reflecting that risk differential.
Okay. This might be a silly question, but is it like a hedge situation? So if the company does well, the credit does less well? Or is it like, no, if the company does well, both of those ships rise?
With private credit, especially mezzanine structured, both ships rise. But normally your equity ship rises higher and faster.
Okay.
But the debt gets paid off, and normally there was some a sweetener or something in there where they get some juice at the end too.
That's right. Generally speaking, if the company does well, all sort of parts of the capital stack generally do well. I mean, that's the point. Now, if it's on the middle ground where it does okay but not great, that means that probably the lender is going to do just fine, but maybe the equity is not going to be doing quite as good, right? So you can find scenarios where maybe the relative return is actually about the same.
Very much so, yeah.
And part of business is like that.
Yeah. And this is also where it ties into our previous episodes, where it's like that initial negotiation of where you fall in the waterfall and when you get paid out can make night and day difference.
Yep. It's both initial negotiation, but also continued negotiation as the company evolves. As Ed and I have worked together on some of these deals, literally over like the last 15, 20 years, it's like, there's a lot of times in which you restructure a business and you're renegotiating the positions of all the capital providers in that stack, multiple times over the life cycle of the business. That's how it goes.
Is there an equivalent of, like, when you hear about diluting equity or splitting shares, is there an equivalent for the credit side?
Good question.
I have stumped both of them.
Not really.
Yeah, the way you asked the question,
what you end up because it's not like shares to dilute. It's basically what could happen is you end up with someone who's in a mezz position, and then they add additional senior debt above you, and normally there's a restriction. Mezz folks will put restrictions on kind of how far they can get buried in the cap stack. But normally that's going to end up being if you have a formal restructuring or a receivership or a bankruptcy, that's where, you get the pennies on the dollar.
Well,
the mezz folks may get, where the senior secured may get fully paid.
Yeah.
The mezz folks may get 40 cents, 30 cents, 10 cents on the dollar. Equity gets nothing.
Right. But to the maybe the thrust of your question too was around, hey, no matter what position that you're in the capital stack, can you see your return kind of be diminished? The answer to that is yes. And like even though it's not share based in the debt side, credit part of it, I've been the cause of this in other businesses where you do all this work with a lender to put a facility in place. And the markets move and you're able to refi that debt out, you can kind of screw the lender because they went into it with the intention, like, I'm going to get a rate of return of, 12%. But if you refi that out, yeah, sure, you're paying back all the principal, but you do it quickly, they're not going to get a 12% return. It'll be much less than that. So it's just like it is in the, personal mortgage industry, right? Or like, you're constantly finding better rates and you're trying to, get the best deal for yourself. Well, every time you do that, unless there's specific structure in place where returns kind of guaranteed, which in a lot of cases that is how it works, that lender can kind of screw you for all the time, effort, and energy, and even risk that they put into it, but then they don't get the return from all of that.
Well, I'll give a real world example. And Emily, you probably weren't aware of this, but the last company we worked together at, we had senior debt provided by Silicon Valley Bank. We did an acquisition. The seller did seller financed debt, which had to subordinate to Silicon Valley Bank. And so they had a higher interest rate and we were making the payments. But when COVID hit, we flunked covenants. And so Silicon Valley Bank said, you will no longer make payments to your junior, to the subordinated debt. And so we had to stop making payments. We had to stand still at those debt payments. And so that was,
there you go. It's a perfect example
where they were like, wait a second, what do you mean you're stopping the debt payments? And we're like, sorry, the senior lender has a provision where if we tripped covenants, you don't get paid until we're back into compliance. And so that's going to be a couple quarters and, have a nice day.
Yeah.
You got to read the fine print.
Well, and there's not, you do, but it's also understand where you're at in a cap stack, and you can get kind of disintermediated temporarily or permanently, depending on kind of what it looks like. But that's one where it was a temporary. They ended up getting made whole at the end when a company sold. But until then, it was, you're getting some of it, you're getting none of it, you're getting, this quarter you're fine, next quarter you're not, and because they were in a subordinated position.
Yeah.
All right. Final thoughts, takeaways for our listeners: private capital, private equity.
So on a private debt side, you had mentioned there's more money flowing into there now. And part of the reason for that is as you have uncertainty, you want to reduce the risk. And so that makes it more attractive. You go higher on the cap stack, you're more likely to get repaid. The cash flows are a little bit more predictable.
Right.
You're willing to take the market itself is riskier. So you're shifting your asset class a little bit by taking less risk in that asset class by shifting over from equity to debt. And it's it truly is a really useful and probably underutilized tool. A lot of founders, I think, probably would have been better served to look at a private debt placement.
Yeah, that's a good call.
Rather than private equity where they're selling off ownership. You get less dilution, and while it might feel a little bit worse, at the end of the day, you're going to end up having a much higher upside.
Yeah. A lot of that big time in in the venture world where venture debt is a thing, where you get your first institutional round of equity, you layer on you basically take less equity, more venture debt. Venture debt wants to come in with institutional investor, and you don't dilute yourself as much. So, I think that companies like some of the ones that Ed and I have worked for, where they don't go through that venture debt round, they just kind of go through bootstrap to private equity, is, to Ed's point, should consider the private credit route in conjunction with any private equity that's, considered. So, there's a myriad of things. And I think the only thing we wanted to take away, one of the things we want to take away is just, what does this term mean? You hear it thrown around so much these days, but it's not something that's new. It's just something that is focused on now. And, hopefully we've demystified it a little bit, the same way we've done that with private equity as an asset class.
Yes. So, dear listener, now you know what PC stands for. You know about the debt side. You know that being disintermediated is bad. You know that being in the mid-mezzanine level is good for both cap stacks and theater viewing. And you can join us next time for the next round of the Risk Premium drinking game here on the Private Equity Experience podcast.
Yeah, can't wait.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.